Interest rates are being talked about a lot at the moment. So to find out what's going on, I'm going to chat to our in-house expert, Kate Anderson. The Bank of England recently put their base rate up to 4.25%. Do you think this is going to happen again? And if so, how high do you think interest rates are going to go in 2023?
I think we can expect it to happen again. It's not going to be at the rate that we've seen, but there's probably more room to go a bit higher. So the last meeting we saw they went up by 0.25%, which was a smaller increase than they've been doing since September. They've got Bank of England have got another meeting on the 11th of May, and the expectation is that we're looking at another hike for about 0.25%. So we're looking at a base rate about 4.5%. Over the course of the year, I think they're going to start stabilising. Things are starting to improve. There's less worry about the inflation and the cost of things. So we're probably going to see them hit pause and not feel that they have to be constantly doing these interest rate hikes.
Question on everyone's lips. When will the interest rates start to go down, do you think?
That is the question. It is not going to happen anytime soon. The IMF actually came out this week saying that it thinks that interest rates will come down to pre-pandemic levels at some point. But currently, it's not going to be happening within 2023 or 2024 even.
What does this mean for people that have mortgages?
It very much depends on what type of mortgage you have. If you're on a fixed rate, that's it. You're on a fixed rate. It's not going anywhere. And the change will be obviously if you need to remortgage and change that. But if you're on it, you're fine. Standard variable and tracker, they obviously track or move with the base rate. So that's when you'll see an instant difference if there is a base rate rise, because you will see your mortgage repayments go up by a certain amount each month.
So similarly, do you think mortgage rates will go down within the year?
We're starting to see some big lenders like Nationwide are starting to cut rates, HSBC. That we'd already seen the 5-year fixed rate starting to come down from their peak last September after the mini budget. 2-year fixes are starting to come down as well, and it's that higher LTV as well. So there's 90%, 95% LTV, which if you're a first-time buyer are the kind of key areas that you want to be thinking about.
What else will this rate increase affect?
Well, you've got your borrowing costs, obviously, that we talked about with, for example, mortgages, but you've also got savings. So while borrowing gets more expensive, you can also earn more on your savings. So for years and years and years, we've had very little attractive interest rates and savings, whereas now we're starting to see things come through. So you can get an instant access account for about 3.5%. Which obviously is great. If you want to lock your money away for a longer period of time, fixed rate bonds will offer you a bit higher. Regular saver accounts, which is saving a little bit but quite frequently, you're looking even at a rate of about 7%, which is a decent return on your money.
For anyone who's hearing a lot of information around interest rates and going, now's not the time to get a mortgage, but it is the time to get a savings account, and I should be doing something to combat or to work with what's going on at the moment, what would be some advice, or what would you say people should be focusing on?
It very much depends on what your situation is. So general rule of thumb, your personal finance is look at your expensive debt first. And by expensive debt, we're talking about credit cards, personal loans, those with the really high interest rates that if you're not making your repayments, compound interest can put you in a world of trouble. Then if your mortgage is set, then turn your attention to savings, but that's only if you sort of feel you've got that room within your budget and that you can make all your debt repayments that you need to make. The idea with savings is to build up your emergency fund first, and that's something like an instant access account can allow you to do that. And then if you want to go beyond that, obviously, and you feel you can tie some money up for some time, then you can look at fixed rate bonds or notice accounts. Very much what works for you and what we're looking at your finances as a whole.